So this is part number 47 of this multi-part video series for positional stock traders. So we are coming to the end. After this, three more videos remaining, after which I will end this series. It's a fantastic series. It's a course in itself. If you watch these, if you watch this series twice, your approach towards the stock market will become very professional. In this video, I am not going to tell you what I will be discussing. I just want you to understand or listen to this discussion and then decide after listening whether this discussion was worth listening to or not. I am very surprised that a lot of my subscribers and even some of my students are still not aware of the basic risk management calculations. Okay, and if you do not understand risk, how will you take advantage of the risk management formula? So let me put some numbers to this so that you will have a better understanding. And this discussion is extremely important for your trading journey because you will learn certain techniques in this discussion which you can apply when you are taking positions in stocks. Okay. And there will be a couple of conclusions we will draw at the end of this discussion, which will be eye opening for you, which could be eye opening for you. So the basic formula is, let's say you take a 10% position size in a stock, you find a stock, you do filtering, shortlisting, stock selection, you find a stock, you decide that your position size is going to be 10%, okay? And you decide to put a stop loss of 8%. So stop loss means position risk. So let's call it position risk is equal to 8%. So what's your portfolio level risk? This is position level risk, right? What's your portfolio risk? This is position risk, position size multiplied by position risk, right? So 10% multiplied by 8% is very simple. What is 10% of 8%? It is 0.8%. What does this mean? What does this number mean? It means that in spite of taking 10% position size in a stock, 99.2% of your trading account is still safe, which means just because you take a 10% position size in a stock does not mean that 10% of your capital is at risk. It means that only 0.8% of your capital is at risk because your stop loss is at 8%. Position risk means stop loss. So you must understand how much money is at stake here. 10% of your portfolio is not at stake. 0.8% of your portfolio is at stake. That's number one. Number two, this 0.8% is really theoretical because sometimes if a stock collapses like crazy, the stock might collapse so fast that it might go below your 8% stop loss by opening a gap or creating a falling window so that your stop loss never gets triggered. In that case, you might lose more than 8%. But those are rare occurrences. Normally, if you keep an 8% stop loss, stock goes down, it will hit your 8% stop loss. But in rare situations, the stock will completely collapse and it will not even touch your stop loss and it will start falling below your stop loss. That's called gap down or falling window. Rare occurrences. But in most cases, your maximum risk is 8% on the position. Another thing is, not every time you will allow the stock to go to that 8% level. So, for example, if you buy the stock at the correct pivot buy point and you see that next week the stock closes like 1% below the pivot point, you might choose to sell all because remember page number 261, William O'Neill's book. He says that true market leaders don't close below the pivot point. And if it closes 1% below the pivot point on a weekly close on a Friday, you might want to take a complete exit from that stock because it is not likely to be a true winner because it has closed below the pivot. So in that case, your total loss is 1%, assuming you bought it at the pivot. So maybe 1 to 2% is your loss in that case, not 8%. So which means your portfolio loss was not 0.8%. It was probably 0.1 to 0.2%. So you're never going to book 8% loss. Your average loss is likely to be around 5%. Given that on some stocks your stop loss might get hit, on some stocks your stop loss may not get hit. In most of the cases, you will never allow the stock to hit your stop loss of 8%. Okay. Let's take the discussion forward. Let's say the position size. Position size is 10% and the position return. Let's say instead of the stock going down, it starts to go up. So let's say it goes up 20% and you sell the stock. So what's your portfolio return? Portfolio return. This 20% money you have made on the position, not the portfolio. So what's the return on the portfolio? 10% multiplied by 20% is equal to how much? What is 10% of 20%? It's 2%. You don't even need a calculator to do this, right? So what is this 2%? This is the amount of money that you have made on a portfolio level. Okay. So now you understand upside, downside, how to calculate the return and the risk. Now let's buy 3 stocks. Okay. So let's say stock number 1, you take a 10% position size and the stock goes up 20%. So you end up making 2% on that stock. You buy another stock, 10% position size, it goes up 20%, you make another 2%. So how much money you have made in these 2 stocks on a portfolio level? You made 4%, right? Now what you do is third stock, since you made money in the first 2 stocks, you decide to take a big position size on your third stock because it looks, liquidity is okay, comparatives is okay, technically it looks strong, fundamentally it looks strong, market is in a confirmed uptrend, it's an early stage base, there is a blue dot inside the base, there's tightness on the right side, tight spreads, tight closings, very good high quality base. So you decide that you want to take 25% position. Okay. Now tell me how much stop loss you need to keep on this 25% position to risk 2% of your portfolio. Let me repeat that question. How much stop loss you need to keep on this position to risk only 2% of the total 4% that you have made? Think about it, pause the video, think about it. Okay, and then come back to it. The answer is 8%. So if, I'll write it minus, then your return will be minus 2% if the stock goes down. Okay. So if your position size is 25%, your stop loss is 8%. What is 25% of 8%? It's 2%, right? So let's say you buy one stock, 10% position size, 20% return. You sell it here, you make 2%. Why 20%, by the way? Because if you buy in the blue zone, somewhere in the blue zone, and you sell somewhere in the green zone, you measure the distance, generally it is 20%. We have looked at multiple charts. So let's assume that instead of doing partial selling, you sell it completely so that you can use the money to finance the risk on your future trades. So like that, you have 2 trades. So you make 4% on your trading capital. On your third trade, you take a big position size and you keep your stop loss at 8% and your stop loss gets hit. Okay, how much will you lose? You will lose 2%. But notice, you are still in the money. Okay, you made 4% here, you lost 2% here. You are still up 2% on your portfolio. right? In spite of the fact that you took a 25% position size in the third stock, right? You put one fourth of your entire portfolio in one stock. Okay. Now tell me one thing. Does that mean you have taken risk? In my view, the answer is no. Why? Because before you decided to take a 25% position size in a stock, you had already made 4% in your previous two trades. So this 25% does not mean that you have taken risk. So your risk is not dependent on the amount of position size that you're taking. The risk is not directly proportional to the position size. The risk depends on how much money you are willing to risk and where is that money being financed from. If you are financing the risk with your own capital, that's huge risk. But if you're financing the risk with the money that you made from the market, that is not huge risk, right? So just because it is written in some book that 25% is a huge position size does not mean that it is true. 25% is not huge position size. If you are financing that risk from the money that you have already made from the market, this is the essence of risk management that I want you to understand. And this is beautifully explained in Mark Minervini's second book, Think and Trade Like a Champion. Very advanced concept, but please do read that book, it will help you. Now let's assume, now let's take the discussion to the next level, very advanced level. Let's assume that this stock proved to be a good stock pick and it shot up like 100% in a matter of 1 or 2 months. Okay, can that happen in the market? Of course it can happen in the market, and you decide that you don't want to do partial selling on this stock. Why? Because you already made money on these two stocks, so you want to ride this stock. So let's say this stock goes up 100% in maybe 6 months. Okay, for stage 2 stocks that happens. So what is 25% of 100%? It's 25%, right? So how much money you made in by just buying 3 stocks? You made 29% return, correct? 29% is the total money that you made simply by buying 3 stocks. Because this stock doubled and you never sold. You did not engage in partial selling. You were watching the 10-week simple moving average and it just doubled without closing below the 10-week simple moving average. Is it possible? Is it possible that a stock doubles in price without closing below the 10-week simple moving average? Of course, it is possible. Why not? And let's say it doesn't even close, let's say it closed below the 10-week simple moving average on low volume and you did not decide to sell. It continued to go up because it closed on low volume and it went up 100% and you doubled your money on that position. You booked 25%. So, this is the amount of money that you made on the stock on a portfolio level. That's a huge position size, but not huge risk because the risk was managed. Okay. So you made 20% on your portfolio. Not bad return, right? Not bad at all. Very good return on a portfolio level in 1 year, let's say. Let's say in 1 year, you only buy 3 stocks. So the moral of the story is you only need 2, 3 good stocks in a year to make a decent portfolio, decent return on your portfolio annually. Okay. Warren Buffett never made a return more than 15 to 20% in his entire like 6 or 7 decades career. Maybe 20% is his maximum. Okay. 20, 22% compounded annual growth rate. And if you're getting 29% in a year, you should be extremely happy. I mean, how much return do you want? Do you want 100% return like Mark Minervini is doing? Then you take 25% position size on every stock that you buy. I can't do that. I have never done that. So I don't like to take too much risk. This is something that I can do, but standalone basis, I cannot take 25% position size in a particular stock. Now, this is all theoretical. Now, you might say, Rohit, how is it possible that you will only buy 3 stocks in a year? It's not practical, right? I agree with you. It's not practical. Another question you might ask is, Rohit, how is it possible that you put 25% in a single stock out of the 3 and that stock went up 100%? Why not these stocks went up 100%, right? Only that stock which goes up 100%, you ended up putting 25% position size in that stock. You might ask that question, right? Of course, I agree with you. You are right when you ask that question. So there are too many assumptions here, and there are too many unrealistic assumptions here. Okay. So let's make it realistic. Okay. Let's do the real thing. Okay. You are not going to practically buy three stocks in a year. You are going to buy much more stock, many more stocks in a year. So let's be practical here. Okay. Let's assume that you buy one stock in a week. Is that okay? Is that fair enough? Not every week the market is going to be in a confirmed uptrend. So maybe 6 out of 12 months, the market is going to be in a confirmed uptrend. I'm only talking about positional trades. So you may not be able to buy one stock every single week. Sometimes you might have to sit idle for 2 months doing nothing because there is no trade. But in the third month, you get a lot of trades. Okay. So for all practical purposes, let us assume that you take 52 trades in a year. So 52 weeks, 52 trades. Fair enough. Conservative assumption. Nothing complicated here. I am not saying that you are buying one stock every week during the year because the market condition could be in a downtrend. So you're not allowed to buy stock. But when the market does go into a confirmed uptrend or uptrend under pressure or even rally attempt, you are allowed to take positional trades, right? And let's say during those times, you might get maybe two, three stocks to buy in a single day. You never know. So if you average out the number of stocks you buy, let's assume that you buy one stock on average every week. So 52 stocks in a year. Okay, out of 52 stocks, 49 out of 52 stocks, you take a break even on them. Break even means what? Means 49 out of 52 stocks nullify each other, which means you make money on uh, some stocks, you lose money on some stocks. When you add up the profit and loss of these stocks, you end up break even, which means on 49 out of 52 stocks, you don't make any money on a net level. Okay. Because the stocks nullify each other's gains, the losses nullify the the gains, and the remaining three are these. Okay, let's assume that the remaining three are these. So let's break these 49 stocks. Let's assume that for every one stock on which you make a profit, you have two stocks on which you make a loss. Okay, so one winner is like equivalent to two losers, correct? So for every one stock on which you make money, there are two stocks on which you lose money. Okay, so out of every three trades that you take, you make money only on one stock. Is that a fair assumption? Of course, it is a fair assumption. So one third of 49, you will lose money. Okay, sorry, you will make money on one third out of 49. So what is, I have this calculator here. So what is one third of 49? 49 divided by 3. So 16.33. So let's say out of 49, you have, so 49 stocks, you have 16 winners and 49 minus 16, 33 losers. Okay, now remember what I told you. When you lose money on a stock, the chances are very high that you will not allow the stock to reach 8%. So your average loss is likely to be less than 8%. Let's assume it is 5%. So on these 33 stocks, you lose 5% each, correct? Your average loss is 5%, correct? What's that equal to? So 33 multiplied by 5. You lose minus 1. Your loss is minus 165%, correct? So you are losing 5% on 33 stocks. Understood? Okay. And on the remaining 16, how much are you making? 16 winners. So let's assume a reward to risk ratio of 2:1. So if you're losing 5% on a stock, you're making 10% on a winner. So your losers are minus 5%, your winners are 10%. Now, this is a positional trade. You are not even allowing the stock to reach the green selling zone. You are selling it at 10% level. So somewhere in the middle between the blue zone and the green zone. Is that a fair assumption? Yes, because not all winners will reach the green selling zone, right? So on an average, on those 16 stocks, I am saying that you make 10%. Okay. So that's total of how much? 160%. So can you see you make 160% here, you lose 165% here. So that's total minus 5% on a position size of how much? Assuming the position size on all this is 10%. Okay. So 10% multiplied by this minus 5% is equal to 0.5%. Okay. Minus. This is the amount of money that you lose. This is your net P&L on 49 stocks. Okay. The total amount of money that you lost on a portfolio level is 0.5%, which is break even. Basically, you don't lose anything. It's hardly anything, 0.5%, half a percent of your portfolio. So it's basically break even. Okay. And what about the remaining three? The remaining three is these three stocks. 2%, 2%, 25%. Is it possible? Of course, it's possible. So how much is your total return? So 0.5% plus 29% on those three stocks is equal to how much? 28.5% return in a year. Is that a bad return? Of course not. 28.5% return means you're doubling your money uh, every 2.5 years. If you make this kind of money in a year, you're doubling your money every 2.5 years. Your portfolio will double every 2.5 years if you make that kind of money. Okay, that's not a bad return at all. So now tell me, how many stocks were actually winners and how many were actually losers? So 16 plus 3, right? So 19 winners, 33 losers. 19 winners. I want you to watch this video twice, thrice, till you understand this calculation. If there is anything in this calculation you do not understand, that means you are not a professional trader. Okay. 19 winners and 33 losers. Correct? 33 plus 19 is equal to 52 stocks. So 19 divided by 52 is equal to how much? 36. 19 divided by 52, 36%. This is your success rate. So out of every 100 stocks you are buying, uh, only 36 are making money. Okay, out of every 100 stocks you are buying, only 36 stocks are making money. Is that a conservative assumption? Tell me honestly, is that a conservative assumption? Of course, it is a conservative assumption, right? It's like you are buying three stocks, out of which you are making money only on one, losing money on the other two, approximately. Okay. Why is this happening then? Why are you getting a good return with a poor success rate? It is because of the reward to risk ratio. When you lose money, you lose small. When you make money, you make big money. Okay. Now the trick here is to to be able to finance the majority of this return. Almost 80 to 90% of this return has come from a single stock, this one. So the trick is to find such stocks in a year. Even one stock in a year like this is more than enough for us. But we should be able to find that stock. We should have the courage to put 25% of your portfolio in the stock, and we should have the money to finance the risk on that stock. So, to finance the risk on the stock, there might be some stocks on which we have to sell uh, uh, at 20% level all of your position. So, not on every stock should you be taking partial profits. On some stocks, you might have to take full profits in the green selling zone just to be able to finance the risk on this one stock, which will produce extraordinary return for you in that particular year. And one stock contributes to majority of the return. Remember that Pareto principle. It 20% of the work tasks that you do in a day account for 80% of the value that you create during the day. I will repeat that. 20% of the work that you do during a particular day account for 80% of the value that you create during that day. That's for productivity. Similarly, 20% of the stocks that you buy in a particular year will account for 80% of the returns that you made during the year. So there will be a very few stocks, maybe 3 or 5 stocks in a year that you will buy that will have a significant impact on your portfolio. And in those 3 to 5 stocks, you need to have a big position size. And to have that big position size, you need to take small position size, make money on them, book full profits rather than partial profits, and use that money to finance the risk on the bigger position. Okay. And when you are taking a bigger position, ensure that almost all of the factors meet all of our criteria. So liquidity, comparative, technical, fundamental, market, everything should be in our favor. It should be a high quality base, should be an early stage base. There should be tightness on the right side. The stock should set up on the daily as well as the weekly time frame chart. When all of this comes in our favor, only then it makes sense to take a 25% position size. Okay. So remember, the moral of the story is this. Remember, at the start of the video, I told you that there is a moral to this story. The moral of the story is, as a positional stock trade on the weekly time frame chart, or even on the daily time frame chart, you don't need too many stocks in a year to make a decent return on your portfolio. Decent means anything between 15 to 20%. Anything more than 20% is bonus. Okay. Because I am comparing against Warren Buffett, okay, who is the best stock market investor in the world. And I'm assuming you're taking 10% position size. If you're trading with a 25, 30, 35% position size, then your returns could be phenomenal, like Mark Minervini, where he's consistently able to generate triple digit return. I'm not talking about that kind of level of skill. I'm talking basic level of skill where you are able to take 6.25% position size or 10% position size, or even somewhere between 6.25 and 15%. If that is the position size you're looking at, you can aim at a decent return. Okay, 15 to 20% or slightly more than 20% in a year. On an average, you will end up making 15 to 20%, just like Warren Buffett did on your portfolio. And that too, it depends on your skill. You are going to make a lot of mistakes. Even I make so many mistakes in the market. Okay. So don't worry too much about the return that you are making in a particular year. Focus on the skill, focus on managing the risk. Whatever you earn is in your destiny, but you have to focus on professionally taking positions in the stock market. Okay. So you need, the moral of the story is, you need very few stocks in a year to have a decent impact on your portfolio. That's number one. Number two, just because you take a 25% position size in a stock does not mean that you are taking risk. Okay. Because you know that the risk is financed, you know that the risk is managed. So you need to have your own definitions of risk. Okay. So if you have made money in previous 3 4 trades, there is nothing wrong in taking a big position size on the next stock if the stock looks very good. Okay. That's risk management for you. That's a very powerful risk management lesson for you. If you understand what I have discussed in this video, you don't need to read any book on risk management or anything like that. You can play around with these numbers. I have taken 10% here. You can play around with this 10%, 6.25%, 15%, 20%. You can play around with stop loss 8%, 4%, 5%, even 10%. Up to you. As long as you know the calculation, you can do whatever you want in the market now because you understood the risk management formula. Okay, you understood that even if you put like one fourth of your portfolio in a single stock, that does not mean that you are taking risk. Okay, if somebody looks at the history of your portfolio, and if he sees that you are taking a 25% position size in a stock, he might say that no, this is not huge risk because this guy has made money in the previous 3 4 trades uh, before taking this big position. So that's called professionalism. So I want you to become a professional positional stock trader who is actually a risk manager. Thank you so much.